$514 billion. That's Alphabet's cloud order book after the bell today, a record, and it just started converting to revenue more slowly. 3 tapes to unpack tonight: Alphabet's slowing backlog burn, Cisco's inventory paradox, and Thermo Fisher's disappearing cash. Start with Alphabet, because the interesting number is not on the press release, it's buried in the quarterly filing. The filing states Alphabet expects to recognize just over 50% of its remaining performance obligations as revenue within the next 2 years. A year ago, that identical disclosure line read approximately 55%. Same sentence, same time frame, 5 percentage points slower conversion. And here is the twist that makes this line jump off the page: between those two filings, the order book grew nearly fivefold. So the backlog is dramatically larger, and the share burning down within 2 years is smaller. Cloud customers appear to be signing longer, larger contracts, but taking longer to actually consume the capacity they've committed to. The filing does not say whether that reflects Alphabet's own capacity constraints, delivery timelines, or simply patient enterprise buyers. For the headline hunter, the record dazzles; for the analyst, the conversion math is the real pace. Second tape, Cisco Systems, one of the clearest after-hours results of the day. Q3 fiscal year 2026 revenue landed at $15.84 billion, up 12% year-over-year. Net income climbed to $3.37 billion, up 35.4%. The engine of the quarter was networking products revenue. There surged 24.7% to $8.82 billion. Cisco itself framed that surge as the company entering an AI infrastructure demand cycle. But scroll to the balance sheet and one line stops you: inventory, up 49% year-over-year. That number reads two ways. Reading one is Cisco is pre-positioning components for orders it already sees on the calendar. Reading two, an inventory build that turns to write-downs if AI networking demand cools even a quarter or two. Management leaned hard into reading one, guiding Q4 revenue growth of 18%. That would mark an acceleration from the 12% just posted, and it's the number the tape will trade on tomorrow. Third tape, Thermo Fisher Scientific, a slower burning story but the same pattern. Q2 2026 revenue came in at $11.994 billion, up 10.5% year-over-year. But strip out acquisitions, and organic growth was just 5%. The gap between the headline and the organic number is the acquisition contribution, and one deal defined the quarter. Cash on the balance sheet fell 58% after Thermo Fisher closed its Clario transaction. That is the mechanical cost of buying growth when the organic engine slows. The question hanging over next quarter: does organic re-accelerate, or does Clario have to justify itself on standalone economics? 3 tapes, one shared thread: backlogs and inventories are swelling faster than the revenue that has to work them down. Alphabet's cloud book grew nearly fivefold, Cisco's inventory jumped 49%, Thermo's cash halved. Each is a bet that demand shows up on schedule. Watch at tomorrow's open how the street prices Cisco's 18% Q4 guide against that 49% inventory build. And whether Alphabet's slower conversion window reprices the cloud growth premium once the filing gets fully digested. That is your snapshot after the bell today, August 15th. Full breakdowns are at LineVestnews.com. Subscribe to LineVest Daily to get every open in your inbox.